I sold 2 policies to an 83-year-old this last year, and he bought them on his kids because he's got all this money. And he's like, what am I going to do with the money? And his kids are clients of mine. So I said, well, just buy a policy on each one of them. And then when you die, they inherit the policy full of cash value. But in the meantime, he owns it and he's lending them money for the farm and ranch anyway. So he's just going to lend them money out of their prospective policies. And then if they don't pay him back, they inherit a policy with their own loans in it.
Listeners, welcome to the Farm4Profit Podcast. Corey and Tanner here. Dave might pop in a little bit later, being fashionably late.
Well, he was here.
He was
here on time. Then he went. He's got a kid event, and he's gonna come back.
Got a track day or what is it? A ninja warrior race or something like that.
Yeah, he's always so.
Yeah, but that's nonetheless. We have an exciting guest joining us virtually in our virtual studio. One that's been requested a lot from you as a listener. So thank you for sending those ideas to farm4profitllc@gmail.com. We listen sometimes. And this is one of those times. We've got Mary Jo Irmen here. She is the founder of withoutthebank.com. And I know there's going to be way more to the introduction that she's going to do to herself to help share with you guys the perspective we've got. So Mary Jo, welcome to the podcast.
Thank you for having me. I appreciate it.
And first of all, I have to thank you for your energy. Sometimes we get those guests on where it's like, we're going to get this person woke up. I think she woke me up.
Yeah. No, she's very bubbly today. Started off, I was giving her some crap about not driving here because she came all the way to Iowa for Barn Talk. But, hey, we can catch her when we want on the virtual studio.
Exactly. Yeah. And now we get to send Barn Talk a bill for advertising their podcast. So Mary Jo, you make a lot of content, and your content is eye-opening to many people, and I'm excited to discuss it today. But let's start off first with, how do you introduce yourself?
Well, I just say that I'm a teacher of the infinite banking concept, but then I am also the author of Farming Without the Bank and Life Without the Bank, soon to be other Without the Bank books. But we're right now we just got 2. But that is, and I'm, for me, it's a big deal of making sure that the farming industry has a change in the way it's financed. So I'm mostly focused on the farming side.
So what was your background that led you in and down this path? Did you grow up on a farm?
I did. Yep. My dad was a farmer rancher. So we had a purebred operation, and they dispersed early 90s because we had Charolais cattle, and that just went downhill pretty quickly. And so they were just farming, and I learned about the infinite banking concept. And I was like, oh my gosh, this is exactly what farmers need. The amount of money they're borrowing is crazy. And farmers said, oh, you don't know what you're talking about, lady. So I'm not paying attention to you. And nor do I need you, because corn is $7 a bushel. Mm-hmm. So we don't need you. We're already farming without the bank. And I'm like, oh man, okay. So I'm Henri because I'm 100% German. Uh-huh. And I thought, well, you've met your match. So I am going to write a book, and you don't get to talk to me until you read it.
There you go.
And then they got it, right? They were like, oh, she does know what she's talking about. And they got the concept, and they understood how it worked. And so it's just exploded since. But yeah, it was a tough road because farmers are ornery.
What year did you write that book?
Oh, that's a good question. 2014, I believe.
Wow. So you've been at this for a while.
Mm-hmm. I've been teaching infinite banking for 14 years, and the book, I think, is 10 years old.
Nice. So have you ever worked in banking?
No. Well, I was a teller. Does that count, Tanner?
Absolutely.
That's a bank. That's in a bank.
Absolutely.
I worked at the bank as a teller, and I sucked at that job. I'm not going to lie. My till never balanced ever. I was like, I either gave you too much money, or I didn't give you enough money. I sent food stamps through, and I just sucked at that job. It was awful.
But the dollar bills in your purse or in your wallet, do they all face the same direction?
They do. Yes.
No, yes. It rubbed off just enough.
I don't think that's a banking thing. I think that's an OCD thing.
Oh,
my mom.
No, it's a banking thing.
Is it?
It's a banking thing. Your dollars all go the same direction.
Well, my mom, when I was younger, if I had them, she would take it and just get them all going the same way.
Yeah. I was helping my brother-in-law. He's got a small catering business, and I was taking the money, and I looked at that cash register drawer when it first opened, and I almost broke out in a cold sweat. Like, how do you function?
Yeah, my daughter handed me money a couple weeks ago, and I was like, oh my gosh, turn your money. Like it's all, not only is it all crumbled up, it's not flat, it's not same direction.
Yeah.
Or if I'm at a farm show and somebody is helping me sell books and they put the money and it's not all in there, I'm like,
you're fired.
How do you even know what dollar that is? Like, what bill that is? It's not the right direction.
Yeah.
That's definitely something I learned.
I don't hand my wallet to my wife anymore, because when I do, it comes back with all the bills purposely rearranged.
Oh, it's better than coming back empty.
Well, that's true. That's true.
At least you got the money back.
Yeah.
Yes.
So you've been teaching this for 14 years. What was that aha moment that made you, I have to do this, right? Like what?
Yeah, so I learned about the concept in 2010, so right after the fall of 08 and 09, and I hated the market before then. So I was just working for a CPA at the time, and they're like, oh, you really should have your money in the market. And I'm like, well, I don't want your 401k, but what else do you do, right? Because I had already, when I was 23, I was already reading Robert Kiyosaki stuff about real estate investing and passive income and those sort of things. Working for the CPA, had a 401k, left the CPA, the market crash happened, and then I was irritated as all get out because my financial advisor said, hang in there, it'll come back. And I'm like, that's the dumbest advice I have ever heard, because I worked for that money. That's supposed to be there. You mean I'm supposed to just accept the fact that I lost money? That is not how Mary Jo works. And so after that, then I was looking at penny stock, and I was reading every book I could just about the market and kind of how to get ahead. Because not only was I reading Robert Kiyosaki, market stuff, but then I was listening to people like Dave Ramsey and Susie Orman. So I'm like, okay, you save all your money and you get out of debt, and then you're supposed to buy real estate. Well, how in God's green earth are you supposed to do all of that at the same time? And so I came across the infinite banking concept and thought, well, that's too good to be true. These people are going to prison. There is no way you can do that. And so I continued to just dig into that. And I was like, this is insane. This is real. This is like, you can actually borrow against your whole life. Like, why have I not read this? But it was Yahoo at that point. Like, there was no Google. Internet was just kind of starting. There wasn't a lot of information out there. So I just dove in, and I flew to Birmingham, went to the conference, Nelson Nash's conference. He's the founder. Met Nelson, had a whole room of people doing it that had already been doing it for many years. And I was like, this is crazy. And so there was no going back. I was all in. Quit my job I was a PNC agent. So I quit my job at the insurance agency, and I was like, everybody's going to love this. And they didn't. They all thought I was an idiot. And so I starved for a long time.
Yeah.
But eventually they started listening.
So Tanner, as a former banker, did you know about the infinite?
I've commented. Yeah, I do know about.
You get taught that in banking school?
No, you don't. They do not teach it in banking school. But honestly, Mary Jo's content is what really opened my eye to it. I knew a little bit about it, like I said, through some of the books that she's cross-referenced there. But then her content's really helped me build this. But to start with the skeptics, right, Mary Jo? Got two questions to ask you. Mm-hmm. Did we pay you to be on this podcast?
No.
Have you paid us to be on this podcast?
No.
So
our address is no. That's how we're going to farm without the bank.
The goal is for this to be a way to dive into the concept, to be able to, for our listeners, take this and allow us to learn right alongside them about the concept, about something that might provide extreme value to their operation or might not be a fit, right? Because there are some people, right, Mary Jo, that you don't win over.
Yes. And there are some people that should not be their own banker.
It's fair.
I had some clients last week that I said, I'm sorry, I can't help you. You guys don't have any idea what you're doing. There are people that should not be their own banker. Yes.
Do you have to act like a loser to be your own banker?
Yeah.
Well, Tanner would know, right?
Yeah.
This is what I've learned is that when I first started this whole process, I was like, oh, farmers, poor farmers. The banker is so mean. And I was all against the banker. And the more you get into people's numbers, I counted them not so long ago, over 2,000 one-on-one meetings with farmers.
Whoa.
And so when you get into numbers all over the country, all different sizes, all different kinds of operations, all of a sudden the banker is not the bad guy. Because if your banker is taking advantage of you, it's because you don't know your numbers and he can take advantage of you. And so not all bankers are going to be like Tanner, where they're going to be the good guy, right? And I'm going to say that because Tanner has commented on my stuff. Like I've asked you questions about stuff. You've been gracious to educate while you were a banker on social media. Most bankers will just be condescending jerks and they're scared I'm going to take all their business. I am one person out here and the banks are terrified of me. Like what in the, why? I'm one person. But at the end of the day, if you can't pay your banker, you don't know your numbers. And if you don't know your numbers, you shouldn't be your own banker.
Mm-hmm.
And so the bankers are asking stupid questions because people don't know what they have for numbers. And so the banker is no longer the bad guy. Like I don't prefer to go to them. I prefer them to be my plan B, but I do use them. And now I understand why they ask the questions they ask. Because they just want to make sure you can pay that back, So it's been eye-opening to me because I really thought, oh, these poor farmers, they're the victims when they're just kind of bad bookkeepers.
I think there are some times to where they enjoy the role of playing the victim. But we know with our audience, there are a extreme number of intelligent people. And there are people running their businesses more like corporations now than the family farm like they ever used to. And that... I'd like to say over the last 5 years, Farm4Profit's helped with that. But there were people doing it well before we started this podcast. Yep. And a lot of our listeners would probably do okay being their own banker. Now, it's an intimidating topic. It's also a boring topic. So that's why your energy is crucial to the success of what you're doing and probably the success of the way you can have an impression on agriculture itself. So start off with the basics. What does it mean to have financial independence when someone works with you?
That means that you're controlling your loan, you're controlling your loan payback, you're controlling how much money you can borrow. Financial independence doesn't mean that we're debt-free. It means that we have money to be able to buy things that produce cash flow. It's all about cash flow.
All about cash flow.
That's a similar, right? Banking and non-banking. Cash flow is king. It doesn't change.
Yep. Exactly.
You don't magically not have bills. We just fund them a different way.
And you would say a lot of farmers, especially the older farmers that have, weathered the storm and have a lot of assets, they're a lot of times cash poor, asset rich. Is that what the saying?
That's the saying
goes. But they don't have the cash flow. They need the cash flow.
Right. Or it's tied up in an asset that can be liquidated.
Right.
Some hold grain, some have livestock herds that continue to expand. But yes, typically asset heavy, cash flow poor.
Okay.
Mm-hmm. But cash flow is king because you can't buy your groceries if you don't have cash flow.
Mm-hmm.
Right. And being debt free, like I always say, debt free is great, but the bum on the street, debt free, but he's begging for cash flow. Right. And so you have good debt, you have bad debt. What are we putting that money into? And how are we funding that combine? How are we funding that tractor? That if it's going to create cash flow, you have a depreciating asset on one side, but is it going to create cash flow to pay for itself? Right. And if we're running our farm like a business, we get that. And if that's what your listeners are doing, they're going to get that. When I'm on social media or I'm hearing people talk about, oh, you can't get anywhere in farming. It's super frustrating to me because all the people that come to me are getting somewhere because they are like your listeners. They've educated themselves and they understand the cash flow piece of it. They're not buying stuff just to buy stuff.
Right.
So when somebody comes to you and adopts this concept, how are they funding these?
With cash flow. Sorry.
Or like, what is the first step, right? Like, so I'm leveraged.
We're looking for when I meet with somebody, I'm looking for where is that money going? Have you bought a tractor or a combine with cash? Right. And some people will say people aren't doing that. People are doing that every day. So I've bought a tractor with cash, or I bought a combine with cash, or I put a building up with cash, or I've bought a $100,000 pickup I can depreciate with cash. Well, you just paid cash for that. Can we take that money and fund our life insurance policy with it, whole life policy with it, and borrow against that and still buy the tractor, still buy the combine, still buy the pickup, still buy the cattle, and then the combine, the pickup won't, but the combine, the tractor, the cattle will all pay that back because we have a loan now to pay on the life insurance side. So that'll all get paid back by the production of whatever you bought should produce cash flow to be able to pay your loan back. No different than if you would go to the bank to borrow money for all of those same assets.
And you pay interest on a loan, but you're paying interest back to yourself then?
Nope.
No.
You're not borrowing your money. So when you put money when you pay premium, those dollars go into cash value. That money in cash value, you're borrowing against it. So you're borrowing the insurance company's money. They left your money in there earning collateral, or as collateral, earning interest and dividends. And so your money is earning uninterrupted compound interest and dividends while you use somebody else's money.
Okay.
But that's how you're starting off. If someone is coming from a traditional banking situation to where they've pledged their tractor as collateral, or a pen of cattle as collateral, or real estate as collateral, in this concept, you are taking cash and funding a whole life policy is step one.
Correct. And we're going to use, maybe they have loans that have been paid off. Like when I see somebody's numbers, I can see where the money is going. I don't need many numbers to figure that out. But if we have an operating note, let's just say our operating expenses, our total farm expenses for the year are $3 million. But we only have a line of credit, and we have a line of credit of $1 million. That means we're funding that operation with $2 million of cash.
Yep.
They're going to tell me they don't have any money because they don't. It's just rolling back in. But that's $2 million of cash that went through your hands to fund your operation. Can we redirect some of that $2 million into a policy so that we can start that?
How big of a policy would that take?
Everybody is going to be different. I have policies that are $4,000 a year, and I have policies that are $500,000 a year. It really depends on how you handle money, because I might have a 20-year-old that's like, yeah, I can do 20 grand a year. And I might have a 50-year-old that's like, ooh, 20 grand a year, that's a lot of money, right? So if it's somebody that's really good with money and they hustle and they create cash flow and they understand how to manage their books, that can be a bigger number. But we're not going to stick 2 million in there right away and go, oh, look, you're using 2 million of cash, we're going to put $2 million in there. No, it's a process of slowly moving that away from the bank and making the bank plan B. We don't want to depend on the bank. If we want them, great, fantastic. Now I just made a better client for the bank, because their debt is, if they have any debt, it's in life insurance. So it's a slow process.
Yeah. You're not saying just cut the banker out of your life. You're saying use them as a tool. Don't be dependent.
Correct. Mm-hmm. Correct. I still go to the bank. I was at the bank a couple weeks ago and I was like, okay, I want this loan. What do I have to do? And then she explained everything I had to do. I said, forget it. I'll just borrow from my policies.
I figured they'd be snarky with it. Why don't you just borrow, farm without the bank?
They actually know that I wrote the book too, but they don't care, right? Yeah. They want my money just as much as anybody else.
Well, at the end of the day, I mean, it takes all kinds, right? Like if you're making more money farming and then buying real estate from someone that uses the bank, then they're getting, it's just this.
Yeah.
They need it all. So
Right.
So typically, how long does that transition take? Someone who's in a traditional banking relationship to financial independence. I know it's different for everybody, but what's typical?
Yeah. I have clients that have done it in 2 years, and I have clients that will never see it in their lifetime because it's how much are you funding the policy? Are you scared to fund the policy to the limit you need? I have a lot of clients that will probably never see it in their lifetime because of the fact that they're not putting enough money in the policy. And they're not because it's such a foreign concept that we have to get our head around it first. I am not a salesperson to the point where I am going to push somebody. I'm very conservative. So if I know you could do 100,000 a premium a year, I might say start with 20 just so you get your head around it. And then we can add more policies and we can build that bank just like a bank has more branches. We're just going to keep adding more policies, but the next ones are going to probably be a little bit bigger, right? And then there's some people that read the book and they're like, oh my gosh, I get this. I'm putting in as much money as I possibly can. Yeah. Everybody's different. So I wish I had an answer because everybody asks me those same things. I wish I had an answer to that, but it really depends on the person and their books and all that stuff.
So you said whole life insurance. And this is where I get confused because there's term life and just all this stuff. And it's just, I get just inundated with too much information. Like, so why does it have to be whole life over something else?
Yeah. How much time do you guys have? So there's essentially term life, and I'll try to make this as easy as I can for you, Corey, but there's term life and then there's permanent life. There's only 2 types of insurance. Most agents don't get the terminology right, which is why it's so confusing to you guys. So there's term life and there's permanent. Term goes for a certain amount of years and it's done. If you die, great, your family got the death benefit. If you don't, the insurance company got the money. With permanent life, there's whole life, there's universal life, there's variable universal and indexed universal.
Oh yeah.
And agents will call all of those things whole life, and they are not all whole life because you have whole life and then you have all these universal chassis. So anything universal is going to be tied to the market or reflective of the market. Okay. And they're going to have fees and charges. Whole life does not have that. It's a guaranteed product that grows your entire life. And then we use mutual companies, so they pay a dividend. Not all whole life pays dividend. So we're using dividend paying whole life, and we're structuring it so that the cash value is there right away. When I structure a policy, 75% of that premium is going to cash value. So in 10 days, we can turn around and borrow against that thing. We're not waiting 25 years as if you were to buy old-fashioned traditional, and it's not even old-fashioned whole life. It's just structured differently. So a lot of people are like, oh, whole life is bad because I have to wait forever. Well, it's just not structured the same way, but it's not a bad product. I have people come to me with whole life policies, with mutual companies, and I'm like, oh my God, that policy is amazing. Like you already have $100,000 of cash value there. They had no idea, and they're going to the bank and paying Tanner 8% interest. I'm like, no, like we all like Tanner, but don't pay him 8% interest. Yeah. He can clearly find another job.
Yeah. Yep.
So use that money yourself and then use the bank if you need to or if you want to. So the product is so important because there's so many people out there, even in the farming world. I'm seeing a lot of agents trying to duplicate what I've created, and they're using universal life products. And in 14 years, I've seen 2 decent ones, 2. Everything else, and I see about 2 or 3 a week, everything else will lapse before those people die. That policy won't be there. So we're paying premium and it's all going to fees and costs of insurance and all this other stuff because the market was overprojected.
When you say market, are you talking stock market?
Stock market, yeah.
Okay.
Sorry.
Yep. No,
I
I just wanted to clarify. I didn't know if there was a market for life insurance or something like that.
Yeah. Yeah. Sorry.
So you introduced yourself as a teacher. not a life insurance salesperson.
Correct. Yep. Because I sell life insurance. At the end of the day, I sell the life insurance to teach the concept.
Yep.
But we are teaching a concept. The infinite banking concept is not a policy. A lot of people also think, oh, that's an IBC policy. It's not a policy. It's a concept. It's a thought process around money, creating the cash flow. Like we talk about Parkinson's law and Willie Sutton's rule and all these things and this thought process. If we have the thought process correct, then we can become our own banker with the policy. And we can use the policy as banking. But if we're not thinking about all these if we're not thinking correctly, we're just bad stewards of money, essentially.
And how old is the concept?
Nelson wrote his book in let me look. I have it right here on my desk. It doesn't go anywhere. Like you can see, it's pretty battered.
It's a big book.
It's 2000. He wrote it. Okay. So 24 years.
So it's not
the policies. He wrote the book in 2000. The use of the policy has been there for 200 years. Like that's not new.
Yep. And that makes a lot of sense. So there's a chance that our listeners might have a policy that could work.
Mm-hmm.
Can you roll a policy? Like if they've got one that's kind of close, but would be better off in a different one?
So if they already have whole life with a mutual company, even if it's whole life with a stock company, I am not going to roll it. I am not going to cancel it. If somebody tells you to cancel or roll that policy, they are an absolute money greedy pig. Like that is just not ethical at all to be doing. But if you have a universal life policy, you need to call your agent and get an in-force illustration, and it's going to show you when those numbers go to zero. And those policies, you can do a 1035 exchange and roll that money into a new policy. A lot of times I want to see, do we have to save it? Can we save it? Like, I'd prefer not to ever have to cancel a policy, but there are times where we will do a 1035 exchange and roll that money. But IULs are another new big fancy thing you hear a lot about, and those policies are just trash as well.
So you mentioned don't go to the bank and pay 8% interest. And you mentioned, well, borrow it from yourself, borrow it from your whole life policy. And then you explained that it's money from the insurance company. It's not your money that you're borrowing back. Mm-hmm. So is there a cost when I borrow it this way?
Yep. So if I'm going to borrow against my policy, that's the correct terminology. We're going to borrow against the policy. The life insurance company right now rates are anywhere between 4 to 6%. It just depends when your policy started and all that kind of stuff. So they vary a little bit. Some companies have a standard 8% loan rate. I don't write with those companies, but there are companies out there that do. And so you're borrowing, my clients are 4 to 6. So if you want a lower interest rate, like farmers love me today. Mm-hmm. They're like, oh my gosh, your interest rate's only 4.78 today, where the bank is at 10 or 11, 7.5, 8 for operating. It varies there too. But let's go back 2 years when interest rates were 3% and policy loans are at 4.76. Right? They're like, why would I borrow against the policy if I can go to the bank and get 2 or 3? Well, I went to the bank and got a 2.5% loan. I didn't borrow against my policy. I left the money in my policy and I waited for an opportunity. And land came up and I had the cash. I had the money in my policy to borrow against to buy that piece of ground. And I was able to borrow that. I've got my money in 5 days. And so I could put a nicer offer in that closed sooner without all these stipulations, without any kind of fees and closing costs and appraisals and all that kind of stuff. And so I didn't care if I had to pay a higher interest rate because I was able to offer them less and take advantage of that opportunity.
So how do you decide what your term is on your land purchase, a larger capital purchase like that?
Whatever I would like it to be, because the insurance company doesn't ask.
Okay.
You fill out a form, they send you the money in 3 to 5 days normally. and they don't care if you ever pay it back or not, because if you die, the loan comes off your death benefit. So I'm going to pay it back however I want. Like, I just randomly put money on it. If I wanted to be super diligent, I could run an amortization schedule and say, oh, I'm going to pay X amount per month over the next 20 years, right? Or 25 years.
Yeah.
But it gives you as the farmer the flexibility to say, God, I had a really bad year. Tornadoes went through. I had drought. Something catastrophic happened. I can't pay that back. Then don't pay it back. I want you to at least pay the interest on that so that doesn't compound on you. But if you don't have to pay it back, don't pay it back. Then you can go to the bank and say, hey, I need money this year. And the bank's going to be like, oh, look, you don't have any debt, because the life insurance policy isn't a termed debt that the bank should care about. And I don't know, Tanner, you can speak to that if I'm wrong or not, but you don't have to pay that back because your life insurance, your death benefit is collateral essentially to that loan.
Yeah. So ultimately what she's alluding to is bankers will take your debt and put it into 3 different categories. You'll have your revolving debt, which is typically your operating notes. And that does not count against you for cash flow purposes because it's meant to revolve.
Okay.
You borrow it up, you pay it down. You borrow it up, you pay it down, you pay the interest. Then you have long-term and current portion of term debt. Current portion is what is due within the next 12 months. So if you have a land loan, we would split that up. We would take a year's worth of payments and credit that towards
It'd be like
your current portion.
demand.
Yep.
Yep.
And then you have the remaining balance of your loan there. So we would put that against your cash flow. That's something that you have to pay out of your cash flow in the next 12 months and penalize you. The loan that Mary Jo is talking about doesn't have a required repayment schedule.
So I can hide this from the bank.
Don't necessarily have to hide it. There's no reason to hide it. It's not a debt.
Yeah, but it feels better if I did.
It's not. Yes, and that's why bankers are bad.
I have some clients that hide it, and I have some clients that tell them. And I had a client just this week. He told his banker he has a life insurance policy, and he's borrowed money against it, or he's going to borrow money against it as a down payment for the house. And the banker is just confused as all get out and said, well, can she write something up for me that you don't have to pay that back? And I said, no, they should go buy the book and educate themselves. If they're a decent banker, they wouldn't ask me to teach them the concept. They should go do it themselves. And the client shouldn't have to teach you that. Life insurance, like, you should know as a banker how life insurance works if it's on your application. But he's like, oh, I'll just put it in a different account and then I'll just tell them it's coming from that account. I put it on I have 6 policies. When we went and bought land, I put it on the policy. Like they had 2 lines for me, I think, for life insurance. And so I have no money in a 401k. I have no money in IRAs. I don't hardly have anything in savings. My money resides in the policy. And so I put it all on there, but I do not remember filling out if there was a loan. I don't remember filling out premium. It was, how much do you have in your policy? They did ask my cash value amount, but nobody questioned how that's getting paid back. So some people will hide it from their bankers, especially if you're FSA. They're like, how are you going to pay that premium?
Oh,
Well, that's really high premium. You should be buying term instead of whole life. Or some bankers don't like it because they're scared that I'm going to take a client from them. Like, it's silly, but some do.
Is there a limit to what you can buy? Like, can I go buy a helicopter and 80 acres and my fertilizer?
If you have enough cash value to cover all of those, you sure can. Because they don't ask you. They literally do not ask you why you are borrowing that money. And does not matter. They don't ask you when you're going to pay it back, how you're going to pay it back.
They just send it to you in a suitcase?
Sorry.
They just send you the cash in a suitcase, or?
They just ACH it to your account.
Really?
It is really that simple, Corey. It sounds like it's too good to be true, but it is that simple.
Oh.
And that's the interesting part is, you went and bought a farm. Your farm is still available for traditional collateral. Mm-hmm. If you needed to, you could pledge that and get a conventional loan. Mm-hmm. That's a unique way to think about this.
Wait, can you use the whole equity in that?
Yeah.
from day one.
Like we bought $500,000 worth of ground, and it was valued at 6. We got it for a half. And I borrowed my $500,000 from my policies. And then I went to the banker and said, I want a line of credit on that place. And he said, okay, well, I'll give you a $500,000 line of credit. Huh. Plus, I need your rental property. That's also paid for. And I said, no, now you're asking too much. Yeah. Like, I'm not playing your game at this point because I don't need to, right? But if I needed to, I could have said, well, I'll just do a line of credit against that. Or I'll just do a, oh my gosh, what's the word, Tanner?
A term loan.
Yeah. Yeah. If you be a refi.
You could a cash out refi of your farm purchase.
Refi. There you go. That's
so traditionally you would pay your 10, 20, 30, 40% down. Mm-hmm. And that's all the equity you would have in that farm. And that's all you could borrow against it. Unless you're with the FSA, you can't borrow anything against it until you've got their portion paid off.
Right.
Incentivizing you to pay cheaper interest off, which is stupid. Yeah. But yeah, so that's interesting.
So I have a client that said, he called me one day and he's like, Mary Jo, I was just going to use this for a savings account, a retirement plan. He's like, I had no intentions of ever borrowing the cash value. And he goes, but, we got into a situation where we needed to buy cows. So he borrowed against the policy to buy cattle. He goes, but then we turned around and there was a business opportunity that we could buy this business. So I went to the bank and I used the cows as collateral to buy the business. And he said, I didn't know I could leverage it like that. This is amazing. How many of these can I have? Way more.
Yeah. And see, that's an interesting scenario because in most opportunities when someone wants to buy a business, there's not a lot of traditional collateral that a bank can use to fund a business purchase because you're buying accounts receivable and a book of clients and a phone number list and whatever it is to where you may buy a business for $250,000 and I only have $100,000 worth of collateral I can use. So I can only give you a portion of what you need to buy the whole thing. But I want to go back to the cost side of this. You mentioned that there is interest due. Are there other fees that come along with this?
No. There are no fees to process a loan. There are no fees to take a loan. When you buy whole life, the cost of insurance is figured in the premium for the rest of your life. So it can't go up. It's just set. So there are no additional fees outside of whatever the interest rate is for that policy in that year. And interest can only change per year, and it only can change on your anniversary date. So if your policy starts in January, whatever the interest is in January, it will go from January to January. And it does not follow the Fed rate. It follows the Moody's bond average. So it's not fluctuating like the Fed rates will fluctuate.
So yeah, at the bank, I would have had a doc prep fee, maybe an application fee. If it was land, there would have been an origination charge, an appraisal fee. You're still going to have to do title work if you're going to purchase a piece of ground, at least in the state of Iowa. But that's nice to know that it's a convenient way.
That's going to add up quite a bit on a loan. A lot of $3,000,
a big negotiation point. Correct.
Yeah.
So
that's why I said when I had to pay 4.76, I don't care because I didn't have all those fees and I didn't have the time I didn't have to send over, like the last time we bought land, I had to send over 11 bank statements and then they lost them and then I had to resend them. And I'm like, the amount of time I spent on this, I didn't get a 2.5% loan rate. If you count your time and all the fees and the charges, it wasn't 2.5%. And so 4% versus 4.76, am I really paying more after the headache of answering all the questions and, playing with the circus?
Probably not. Yeah, time is worth a lot. We've learned that quite a bit.
It is.
Sometimes it's a hard lesson.
So how do most of your clients get started? Where's the initial money come from?
Well, that's what we look at in a meeting. So I can see where you're spending the money. Are you buying things with cash? Are you operating with cash? What's happening with the money? And then I can see from there where it needs to start. Some people are like, hey, I just drained my retirement account, so I want to start with the 401k that I had when I worked off the farm.
Yeah.
Or, whatever that looks like. there's many different ways to find the money, but that's the whole point of having a meeting with me is people will say, well, there's no way I can get started. And by the time we're done with a meeting an hour and a half later, I found something.
Yeah.
I found something to start. And there are times where I won't. I'm like, there is nothing to start with here. Like we have some big credit card debt, or we have something that we need to get that paid off first, and then we can start. But it is pretty rare for me to not be able to find something. But if there's nothing there, I'm not gonna say, hey, go buy a policy just so you have another expense when we have expenses that need to get paid off.
Right. We just got done saying that time is worth something. So you have to be charging for your time to do this. I'm assuming.
I don't.
Right? You don't?
No, I don't. I require you to read the book, and that's it. So you have to spend the $20 for the book, and then you get an hour and a half of my time. And I'm going to see what you're doing with your money, but we're also going to talk about what's happening with the estate plan. Where's the vulture in the family? Do we have to be concerned about them? Should we be buying life insurance on mom or dad? Because when they die, do we have to buy somebody out? How old are they? I'm usually spitting out some ideas about, hey, have you thought about doing this for cash flow? Or if it's somebody with cattle, that I'm like, have you looked at buy-sell marketing? Have you looked at regenerative agriculture? What are those things? What are some of those things that my 2,000 other clients have been doing that could possibly help that person? But that's just an hour and a half of my time. I look at it like I just made a new friend. So regardless if you do business with me or not, I have lots of friends.
$12.50 an hour to have a good new friend.
Well, yeah. I was sitting there going, you're not charging enough. It's like,
now we have to teach her about the value of her time.
Where does Mary Jo make her money?
Yeah, I'm a bit of a, like, if somebody charged me to talk to them, I probably wouldn't do it. Right. And so I just am like, if it's a good fit, it's great. You'll buy a policy. If it's not, then so be it. I have a lot more content to produce.
Mm-hmm.
So you get paid on the policy sale.
I get paid commission if people buy a policy.
Yeah.
Yep.
Is there a tax benefit if I buy a policy?
You cannot deduct the premium as an expense because then the death benefit is taxable to you. But you can still pay the premium, borrow against the cash value to buy the tax deductible asset of a combine or whatever it is you're buying, right?
I would assume the interest is deductible.
Oh, yes. The interest is going, and again, it depends on your accountant. I have had some accountants that have said, oh, no, that'll never hold up in an audit. But my accountant was an auditor for 30 years for the IRS, and he said there is no problem. As long as you say, hey, I've bought a $500,000 combine and I borrowed $500,000 against the policy, and those two match up and I have the paperwork, there is absolutely no reason that you cannot deduct the interest that you're paying the insurance company. And if you're using it for operating and you're paying interest only, absolutely. You have those operating expenses. You have the receipts to prove that. Why not?
And if you use it to buy a camper, you just have to take a picture of it hooked up to a wagon or something in the yard.
Yep. For the IRS.
Uh-huh.
So you mentioned retirement before. Say someone actually wants to retire, which is very rare, it seems like, in the farming world at 65, and they didn't have a 401k. They've been doing your concept the whole time. How does that look?
Yeah. So then we have all that cash value at 65, and we start borrowing against that to supplement income. And when we do that, there is no income. You're in a 0% tax bracket because it's borrowed money.
No way.
Okay.
Yep. So we're doing it, and then we're never paying it back. Because at the end of so people don't understand, like people like Dave the Dipstick thinks that I don't get my cash value and my death benefit when I die. Well, cash value is just a portion of your death benefit they allow you to use while you're alive. Okay. So if you borrow that for retirement and you don't ever pay it back, that's totally okay, right? Because the kids will still have enough death benefit. They can split a little bit, they can bury you, they can go do their things, but you're not going to drain that cash value enough to be at zero. Because you have to strategically use it at retirement.
Right.
But what we're doing is we're using that same money and we're borrowing against it to buy land and build our business. And then we pay it back because we're good bankers. We pay it back and then we use it again at retirement, and it keeps us in a lower tax bracket. Your 401k and your IRA is nothing more than a hindrance at retirement. Because now as a farmer, you're taking out of your 401 or your IRAs, right? But now you don't have any write-offs because you're retired. You're in a higher tax bracket than you've ever been in your life.
Mm-hmm. That part I didn't know about. And we are totally clipping the Dave the Dipstick.
He's not here, but that's Dave the Dipstick.
That's going to get used. I love that. I'm glad that you shared that, because I know if I didn't know it, there's a lot of people that didn't know it either. And then when you first started talking about it, it reminded me of a reverse mortgage. And those come with a terrible connotation, because when you do a reverse mortgage, you don't have a house left. Right. At the end of this, when you die in a reverse mortgage situation, you don't have a house for your kids. You don't have something left over for your kids. Like, that's the point. You're using that property until you die or until the end of that term to fund your lifestyle. This, it sounds like there's still something left over.
Well, yeah, because if you have with a whole life policy, it endows, that's a fancy word for saying your death benefit and your cash value have to equal each other when you're 121. Okay. So up until that point, you will always have more death benefit than cash value. So if you've borrowed that cash value, there's still going to be death benefit left. But while you're borrowing it, because you're probably missing this piece too, while you're borrowing it for retirement, you're borrowing against it, right? You're not taking it out. So you're still earning, if you've borrowed $100,000, you're still earning compound interest and dividends on that $100,000. So when we take money out of a 401k or an IRA, we're depleting it and we're earning less on that. Plus we have to take more because we have to pay taxes. Here we're borrowing 100, but we're still earning interest. So that money lasts a lot longer. And if we have land rent, ideally, if we have land rent, we're going to use the land rent to at least pay the interest only on that loan. So that even makes our money last longer.
Okay.
So I have that that whole thing, Corey, is outlined in the Farming Without the Bank book. Like, I have a whole retirement strategy in one of the case studies.
I'm going to have to read this. I'm assuming it's on tape.
It's on audio. Yeah, you can get audio from my website.
We do a podcast, so I got to promote the listening.
Listening to books. Right? We don't read.
Ideally, though, you should probably have both.
Yeah.
What happens if people come in and they're like, okay, but show me the numbers. I'm like, the numbers are in the book. They're like, oh, I listened.
Yeah. Mm-hmm. I was driving 75 miles.
This is why we have so many questions that were answered.
So with compounding interest, it's always best to get in early, right? Mm-hmm. It has the most time.
Yes.
And then I think of life insurance, like, am I going to be healthy enough to qualify for life insurance or the good rate? Like, is there that in this concept?
Yeah. So obviously the compounding for the young people is huge, but it doesn't matter if at some point it doesn't make sense. And that's about 70 for me. I'm like, would I sell that to my mom and dad? Probably not. So under 70 is fantastic. But over 70, like, I sold 2 policies to an 83-year-old this last year, and he bought them on his kids because he's got all this money. And he's like, what am I going to do with the money? I said, and his kids are clients of mine. So I said, we'll just buy a policy on each one of them. And then when you die, they inherit the policy full of cash value. But in the meantime, he owns it and he's lending them money for the farm and ranch anyway. So he's just going to lend them money out of their prospective policies. And then if they don't pay him back, they inherit a policy with their own loans in it. Right? And so younger, yes, is better, but 55 and older is still great. Like, we still have a policy with cash value. It's actually, the cash value in that policy actually grows faster in the first 10 to 15 years because you're going to die sooner. And so that endowment happens quicker than in a policy somebody younger.
Right.
Okay. But there's a whole piece that we haven't talked about yet, and I don't want to run your podcast, but it is the generational wealth. So a lot of people will come in and say, well, Mary Jo, I'm 55 or 60. I'm too old. Let me buy a policy on my 25-year-old. And I'm like, whoa, you're going to die first. And if we buy a policy on you, we've paid about 40 cents for every dollar, 35, 40 cents for every dollar of death benefit that goes to your kids income tax free. Now, if your kids took that money and bought a policy upon your death, and let's say they got $500,000, they're going to turn that into $1 million of death benefit on them. So now that cost of that dollar just went down, and now we're passing it on. When the child dies, the grandkid gets X amount of dollars of death benefit income tax free. And so like I've run that strategy, that's on my website, but I've run the generational wealth strategy that by the 4th generation, we're passing off $44 million. And we started with a $20,000 premium on a 60-year-old.
So maybe it would be better to buy a policy on our parents?
Correct. Yep. If I can sell a policy on mom and dad, if they're under 70, if it makes sense, if they're healthy enough that we can have a discounted, a cheap enough dollar, then absolutely, we want to start generational wealth because we're all out here struggling to save farms. But what's saving farms is everybody's buying it from the next generation.
Mm-hmm.
Well, what if we bought it from the next generation at a discount with a discounted dollar? Or what if we didn't need to buy it because the off the farm kids got the death benefit and the farm kid got the farm?
Just texting dad, tell him to get on the treadmill.
You got 4 years left, buddy. Do you run into points though to where people are uninsurable?
Oh yeah.
Okay.
Yep. And then we have to just insure somebody else. So if you're uninsurable, like in your guys' situation, Tanner, you could own a policy on Corey and vice versa. And because there's a financial loss there if somebody passes.
Yep.
So we're going to then go to kids, grandkids, business partners. Nelson had 49 policies, and those policies were not all on Nelson. He had very few on himself because he was uninsurable. So they were on kids, grandkids, business partners. Like if I have a 20 or 30-year-old and mom and dad are in their 50s, I am going to do as much whole life on mom and dad as I can. And I'm going to do some convertible term on the kids because that is the cheapest dollar. And there is guaranteed to most likely be a vulture that's coming for you when somebody dies. And we need to have plan B.
So if I buy a policy on Tanner, I own the policy.
Correct.
But it's on him. So I can borrow against it. He can't?
Correct.
Okay.
You get access to the money. And you get to decide who the beneficiary is.
But he has to sign off on that it's okay.
He has to go through the health exam.
Yeah.
He has to sign off. He has to give us his net worth, his gross income. Like we have to have that information.
Some random doctor's going to show up at your door some morning. Strap on a glove.
You have to have insurable interest in the person.
Correct.
Yep.
You have to have insurable interest. So let's say that I do this a lot, business partners, where the partnership fell apart and somebody kind of got screwed when the buyout happened, right? Well, if let's just say, Corey, you had a policy on Tanner, your guys' business partnership falls apart, Tanner screws you out of the deal, and you're like, fine, I'm just done messing with you. And so when he dies, you still have that policy. If you die before him, you now can give that policy to your wife. You can have your kids as the owners. Mm-hmm. So your family will recover any death benefit that you have on Tanner.
Like how I'm the one that would screw you over.
That's plausible.
You were the banker, Tanner.
We're bad guys.
Yeah. Yeah. This is definitely interesting. Who the heck came up with this stuff in the dang first place?
Well, I'm loving this because we put out an episode on Monday that we're recording this. So about a month apart are going to be 2 shows. We talked about micro-captive insurance and the ability to be self-insured. Again, it doesn't happen on day one. It's another transitional process. But just imagine the Farm4Profit audience getting to a position to where they don't have to bank with a bank. They can choose to bank with a bank, and they don't have to insure with an insurance company because they could self-insure. And we could have a whole network of independent farmers that are able to make decisions on their own basis, on their own time schedule, with their own best interests in mind. Because how many times have I denied a loan because it doesn't fit my policy guidelines? How many times, Corey, have I explained to you what it would look like and be requirements for you to purchase a farm? And it deterred you from making that decision.
Too much.
Right. It happens a lot. And I think timing wise, I'm not at the bank anymore, but timing wise, if we would have had this conversation while I was at the bank, I think we still would have had the same types of aha moments. So I don't know why. I don't know why bankers fear you as much. I feel like the insurance companies should fear you because of how, like you said, how you work to cheapen the dollar of the policy to maximize its value for your customers.
But that's been there for 200 years. Insurance people have been doing that. Insurance salesmen, right, have been doing that forever. I am making a better client for the bank. We're saving family farms along the process because in those hour and a half meeting, I'm looking at all of this stuff. Like I'm asking a ton of questions and people are coming in and they're like, oh, I don't want to air my dirty laundry. I will find it. Like by the time we're done, I know just by body language, by a few little words, like who's the person we need to be concerned about? Is it mom and dad not planning? That we need to be planning? What's happening? Is it the fact that we're not, because I don't see people that don't handle their books. Like those people don't call me, right? Because those people don't read books. So if the people that I see are successful operations, they're looking for ways to hand that off and to do it correctly. And the bankers, if there are some bankers out there that love me, they're like, their client will take the policy into them and say, should I buy this policy on mom or dad? And they're like, that's the most smartest thing I've ever seen. Yes. And they've just not been exposed to it. I don't know. And then you go back to like Tanner, if you talk about just the bank owned life insurance. It's BOLI. Your top banks have trillions of dollars of BOLI. If it's such a horrible product, then why do the banks own it on their executives? Why do the Rockefellers use it for their operation or for their whole family banking? Like we have to look at what the wealthy are doing. And if we can, the other thing that you touched on, Tanner, that I just want to touch on real quick is you're saying what you can do with your listeners. Your listeners don't have to sell grain or corn at $3.80 a bushel if they don't owe the bank the money. And the bank's not saying, hey, you need to sell today. They can wait until it goes to $5. They can hold it for as long as they want. If they don't pay the operating back to their policy, now they can go back to the banker and say, I need that operating line this year, right? Because they can wait for that better price. Having to sell grain and having to sell at a low price, that hurts a lot of people. But the banker needs his money. The bank does not want your land, and they don't want your tractor, and they don't want your combine or your cattle. They want cash flow. They want the payment so they can go turn money 10 times so they can go lend more money. They want the payment. They don't want the asset, or they would go buy their own assets.
So what's next? You said you got farming without the bank. You got life without the bank, I think. What's coming?
I think we're going to do some real estate stuff and some business stuff.
Could that need crop insurance without
It's all the same. Like it doesn't matter what it is, if it's farming or life or bank or real estate, it all works the same. It's just that people can't see outside of the title of the book. So we'll just write multiples.
Do you
crop insurance? Corey, if I could get my head around crop insurance, I'm not going to lie. I've put some spreadsheets together, and crop insurance is so volatile to be able to self-insure that the best way that I think it would work is you got to insure a bunch of old guys. And then you have to have an age range, right? And you got to have some old guys that are going to pass in the next 10 to 15 years. And then we can start creating the self-insuring piece. And then you're going to have to go all over the country. Because good God, look what happened with tornadoes in Nebraska. You don't want a bunch of people in Nebraska right now.
Well, yeah. Or in 2020, the derecho that came through Iowa and just wiped out, 4 million acres. It's like,
So you want to go like all different parts of the country, maybe mix up your crop types. It's kind of the reason that crop insurance is such a government funded tool, is because insurance companies themselves haven't figured out how they can mitigate that risk. Otherwise it wouldn't be subsidized.
Gotcha. I just got one last thing before I know Tanner wants to wrap it up. Do you have any like a Dave Ramsey call, like I'm debt free or I'm financially free or whatever call?
What do you mean? Do I have the call?
Like, haven't you ever heard Dave Ramsey? It's like he has people call into the show and it's like, all right, do your debt free scream or whatever the heck it is.
Oh, no.
Oh, man. Yeah. I spent a lot of time on the road and he'd come on and people would call in. They'd go, I paid off a house and 3 vehicles and 2.5 years and with an income of $40,000.
Now on Facebook, you see all these that say I'm $440,000 debt free because of cryptocurrency.
Well,
I trade my crypto. Now I got all these things, and it's on this, all those little pieces. But I do think, Mary Jo, we could host a live show where farmers call in and talk about their debt situation, and we have Corey over here to kind of be the.
It would be cool to get some success stories of like, oh, how was it before? And how it is now. Now do your scream.
Yeah.
Yeah.
You hear me scream.
Yeah, I mean, I have clients that I don't have a hotline for my clients to call into. I have themjhotline.com. You can go there and you can call and ask me questions and do whatever. But I don't have, everybody wants the success stories, and I'll hear them from a handful of clients here and there. Like they'll email me and they'll be crying because they're like, you have no idea. Like I didn't have to go to the bank, or the bank turned me down, and this is why the policy means so much to me. And, like I've delivered enough death claims that you can see the benefit that brings to people. Like when I started this, I didn't think about, I'm going to have to go deliver a death claim. And I hand deliver my death claims. If I possibly can, I do not have them send a check. I will drive. That's why I was in Iowa last time, is I had a death in Iowa. I've drove to Kansas and delivered a death claim. And so I am like, that is very eye-opening as a life insurance agent, trying to teach the infinite banking concept that, oh my gosh, that's life-changing for somebody. Mm-hmm. So you hear those stories, but because it is such a freedom, you don't have to, like, I don't know if you're taking a loan. I don't know if you're paying back a loan. Like I have farmers that are just doing their thing, right? They're borrowing, they're paying back, and they're like, I don't need to talk to you about that. And I don't call them and ask them about it because y'all are just too busy to care to even talk. So you're like, well, who cares? Like I got stuff to do, Mary Jo. So why are you calling?
That's right.
Yep.
So if somebody listens to this and this is going to debunk the myths that they thought existed and get rid of some of the skepticism, how do they reach out to you to potentially explore what this looks like for their operation?
So they can just go to farmingwithoutthebank.com, or they can go to withoutthebank.com, grab their books, read your book. After you get your book, you will get a link to my calendar and book your appointment. And that's when we meet and we can determine what we can do, where we can start, how it can work for you, run numbers for you, all that good stuff. And I am booked out usually 3 months, like August. I think I'm booked till the beginning of August right now. And so if I do have a colleague, John, that if people don't want to wait 3 months, they can get in with John within a week or two.
How'd you get her for the podcast so fast?
How did I get her? That's the kind of authority Farm4Profit has. I made her feel bad. That's all I did. Begged and pleaded and showed her a video of me on both knees.
Yeah.
Come on the show. No, this has been our pleasure. Thank you for taking the time. Like I said, we know you're busy. We know that your concept has been one that has caught the attention of our listeners and obviously a lot of people on social media. So if someone wants to follow you on social media, how do they do that?
Oh, they can go anywhere. I'm everywhere but Twitter. So TikTok is, I don't know, just Google my name. It's like or just search my name on wherever you're at. You'll find me. Yeah. Some places I'm farming without the bank. Some places I'm without the bank. Some places I'm Mary Jo Irmen. But if you just put in Mary Jo Irmen, it'll come up.
Well, good.
I'm interested. I want to order a book.
Yeah. That is a great compliment.
Yep.
Because Corey doesn't read. Can't read.
That might be.
Yeah, oh my gosh, let's not even talk about that. You guys all are like, oh, I'm not going to read, but you're on TikTok reading, you're on Facebook reading, you're reading farm magazines. But if it has a spine, you're like, oop, I'm scared. That's a book.
That is a book. It's a book. When do I have time to do that now?
Exactly.
Well, I appreciate the energy, appreciate the attitude and the expertise, Mary Jo. Thank you again for being on the podcast.
You're welcome. Thank you for having me. I appreciate it.
Thanks for listening to the Farming Without the Bank podcast. We hope today's episode has inspired you to take control of your finances in new ways. Don't forget to check out our website, farmingwithoutthebank.com, and engage with us on our Facebook page, Farming Without the Bank. Join us next week as we smash more financial myths and empower you to accomplish your financial goals.